dive into the charts, let's talk about what's moving gold this week, because fundamentals set the stage before smart money makes its move. The first to take into consideration is gold closed last Friday around $4,500, marking its second consecutive weekly decline. So we are already in a correction phase coming into this week. We should keep that in mind. Now here's what is driving that sell-off and what to watch this week. The first to consider is the Fed rates hike threats. The Federal Reserve is now openly discussing the rate hikes instead of cuts. Higher interest rates strengthen the dollar, and a strong dollar pressures gold down. This is the biggest fundamental headwind for gold right now. Consider is Thursday's US GDP and jobless claims data. This is the most important day of the week for gold traders. If GDP comes in strong, expect dollar strengthens and gold could push lower. If it disappoints, gold could bounce. That we shouldn't take for granted. The third to consider is US PCE price index. This is the first favorite inflation gauge. What PCE means more pressure on gold. Cool PCE means gold could have some relief. The fourth to consider is US-Iran peace talk. This is gold wildcard this week. Any sign of peace deal reduces safe haven demand, meaning gold drops heavily. It's also a Memorial Day in the US, meaning low liquidity, thin market spread could widen crazily. Be very careful with Monday entries on gold. So right now the bottom line is that Thursday is the most dangerous and most opportunity day for gold this week. Plan your trades around that section carefully. This is not a financial advice. I'm just giving you a heads up to take the right trades, to take your own trades. Take that into consideration. Before we begin, let's just note that the forex market repeats itself over and over again. Welcome to this channel, and I'm your host. On this channel, we combine smart money concepts and top-down analysis to know exactly where the market is headed. Let's go to the monthly time frame. As a top-down analysis trader, there is the need for you to always come to the monthly time frame or the higher time frame to check out the trend of the market. And as it can be seen over here, the market is very bullish. So there is the need to mark out certain areas. Since the monthly time frame is showing us the trend, there is the need to move to the lower time frame to identify certain areas the market is likely to come to, either make an action of a continuation or a reverse to a demand zone. As any smart money trader will identify on this trend right here, we are still in an uptrend, and any smart money trader will basically identify a demand zone easily. How? By spotting out these levels right here. This is a reaction which the market tapped into for this pull up, for this bullish trend, and then the market is most likely to react from this demand zone to go higher, or the market is going to come and take liquidity over here and come to this second demand zone for the higher time frame move. Now there is the need to mark out all demand zones so you are aware of the level in which the market is in order to take your decision. So we mark out our demand zones. Right here. And that is where liquidity is below right here. Our second demand zone on the weekly time frame is right here. Our second demand zone on the weekly time frame is right here, and this is where liquidity is. Liquidity is at 30,132.30 ounce. That is where liquidity is. Now, since we've spotted out our demand zones, which are the level of interest that we are expecting the market to react from, there is the need to go further down on the daily time frame. Remember, this is a top-down analysis. We combine top-down analysis with smart money concepts, and that's exactly what we are doing right now. So since we are done marking out our demand zones on the weekly time frame, there is the need to move to the lower time frame next to the weekly, which is the daily time frame, to spot out possible levels the market could react from. If you paid critical attention to the video, we mark out this level in the beginning of the video, and it is a very important level or important reaction to look out for, because the market almost always repeats itself over and over again. So there is the need to take note of this reaction, because it is possible the market may react from these zones also. There is the need to note how the market reacted the week before to make decisions also. So we are going to use the rectangle to mark this level as what the market reacted to last week. Pardon me, I have to change the color to make a difference. Okay. I had to make it faint because we'll be marking out some levels as well. So this is how it is looking, and the rectangle we have right here is how the market reacted last week. So there is the need to mark that level also. Now there is a need to also take note critically to the trends, wicks and body close. We react mostly to body close than wicks, so there is the need to mark these levels as well. Now, since this was the last body the market reacted to, the last low the market reacted to, and it gave a wick, there was a strong bearish candle which did not necessarily close below it. Still consider it being a wick, not a candle body close, and the third candle being another wick, the fourth candle closing entirely wick, the fifth candle still under reaction. Now this market is under the reaction of a possible sell limit order around this level. When I move down to the lower time frame, I'm going to spot it out so you note it. The only way we are going to take any decision for sales is going to be when the market closes candle body below our rectangle, makes a retest, and we are going to take it down to this demand zone for sales. That's the only way we are going to take sales. Remember, we are still under the influence of top-down analysis. We are not going to take our entry from the daily time frame or any other time frame we've already analyzed. We are moving on to the lower time frame to spot out other possible levels also. Now we move to the 4-hour time frame. So last week, this was the level I was anticipating for the market to work and then give a bullish onto a certain level I marked, which I have to take my time to spot it out because I already cleared my chart. I think it was up to this previous level I was expecting the market to buy into before a big short comes. Not necessarily a long short per se, but probably a reversal for a continuation because the market already tapped into the higher time frame demand zone. And if the market taps into a higher time frame demand zone, there is the need to consider a continuation. So I was expecting the market after the week. I was expecting it to buy into this level right here, then makes a retracement, a significant retracement, then the continuation. Imagine catching a move from after the break retest down all the way to this demand zone. That would be a switch ride of about approximately 2,000 pips plus 2,400 pips. A very sweet move, and then catching it to the upside will even be a sweeter move. Something like this, something like this will even be a sweeter move. So currently the market is indecisive, and as a smart money concept trader, I wait for my zones to be tapped into before I make any other decision. I've given my idea out for the sales that the only way I'm going to sell is after my rectangles low has a candle body close either on the 1 hour time frame, 30 minutes or 15 minutes. I consider most the 1 hour time frame though over any other for confirmation. Then I go in for a sweet move. As I said, this is a top-down analysis of how I look out for the market. I'll keep on going down until I find a possible level of entry after the opening of the market. Thank you for staying tuned to this.